Hi, my name is Derek North, Enrolled Agent and Continuing Education Director here at Federal Direct Tax Services and, by extension, PreparerTraining.com. And today we're going to be going through the next in our Understanding the Principles of Individual Taxation series, this one titled Deductions. This course is going to be worth 2 continuing education credits in the federal tax law topics category, with the content being aimed around primarily tax year 2024 law, at least with regards to the specific figures. And there will, of course, be some pre-2024 law with some explanations of things that are now no longer present, but are still potentially active and will most likely come into being again in and after 2025, unless they manage to extend some of the TCJA changes. Now, this course is considered beginner in difficulty because it relies upon very little initial understanding of tax law terminology, and you should have learned most of it if you've attended any of the antecedent courses that are in this particular series. Our refund and content update policies are available online or by request, and our contact information and times are available down at the bottom, along with the IRS and the CTEC reporting course numbers. Please note that if you are watching this through an authorized reseller, that your contact information and times and course reporting numbers will be different than what you see listed down at the bottom of this particular screen. Now, Federal Direct Tax Services has been approved by the California Tax Education Council to offer continuing education courses that count as credit towards the annual continuing education requirement that is imposed by the state of California for all CTEC registered tax preparers. You can get a listing of additional requirements to register by contacting CTEC at the address that's on the screen, by their telephone number, or primarily through the internet at www.ctec.org. Also want to point out that at the time of this recording, and for you guys live in the audience right now, it is time and the availability exists to re-register and renew your CRTP licensing with your CTEC 20 course hour requirements available through the portal. So anybody that's out there right now, that is something that is available, and you can get that taken care of right now, and ideally try to make it before the October deadline and avoid having to pay that additional extra $55 on top of your renewal requirements. So what are we going to cover today? Well, the very first thing that we're going to do is identify and define deductions in the context of federal tax law. We're going to talk about differences in both the terminology and the application of various deductions to the return. We're going to identify and distinguish adjustments to income as a subcategory of deductions and how they also apply to the return. Talk about the difference between itemized and standard deductions and when to use either, and provide explanations of the most common types of deductions that are present on the return, and discuss the usage and completion of the Schedule A on the tax return. So, what are deductions? Well, deductions are often interchangeable to most people. They take that as another way to say expense, cost, and sometimes even credit, but that's not necessarily accurate term. To be completely honest, deduction, cost, expense, credit, all 4 of those get conflated and used as one another by people who are not particularly knowledgeable or experienced in the terms that we use that are accurate. So you're going to get used to seeing that, like, oh yeah, I wanted to get some deductions on my business. I wanted to get some credit on my business. Well, you mean expenses, but let's continue. And I'm not saying that you should learn this in order to be pedantic to your clients, but being able to understand these terms, as I said before, in the basic tax overview that starts off this series, the learning of the terms is an essential piece of information because, for one, if you ever have to interface with the IRS, you'll need to know them on behalf of your clients. And number 2, memorizing all of this is a Herculean task, even for the most apt among us, and one should be at least familiar with the terms so that way you know what to look up, because half the job is searching for what it is that you need to find out when you don't know it off the top of your head, or you just forgot it, or that figure just slipped out of your brain. So deduction is not an accurate interchange with expense, cost, or credit. What they are dollar amounts that reduce taxable income in one form or another, thereby lowering the income that is then subject to ordinary income tax. There is a difference between a deduction as a colloquial term and a specific application of deductions as the specific term on the return itself. Now, Subchapter B of Subtitle A, Income Tax, of the Internal Revenue Code, which is itself is Title 26 United States Code, deals exclusively with the calculation of taxable income, including defining income, adjustments, and deductions. Section 62 defines adjustments and lists most of the adjustments that are allowed in the IRC, and Section 63 defines and distinguishes between itemized and standard deductions. And just so that you're aware, that little double S in front of the numbers, that is a section sign or a Silkro or a Paragraphzeichen. Either way you want to call it, that right there is what we're going to use to identify sections. And just as a default, if you see that in front of something today, that is going to mean the section of the Internal Revenue Code. And why am I telling you about this right now? So that way you know it, but will you ever need to use it in the same way? Probably not. It's not necessary to remember the individual subsections. For the most part, your guidance can be gained from the various publications and form instructions that exist, and there is no need to have that in there. But you may see it pop up in some things specifically. You might hear somebody reference it with particular terminology. The most familiar one that I can think of is going to be Section 179, which is a type of depreciation. Not covered in today's presentation, but just getting you familiarized with some of the terminology now that we're moving on past income and some other things in this series. And like I said, it's very helpful to know them, and the more you know, the easier it is to find. And if you want to go into the code itself, then by all means go for it. It is very much going to be jumping from section to different parts of the code all over the place. They make references from one thing to another. It's if you're not a lawyer, it can be a little bit daunting. Now, the statutory rules, and statutory meaning written into the legal statutes, allowing for every individual adjustment, deductions, and so on in the IRC can be generally found in sections 161 through 199A and sections 211 through 224. Now, these statutes will generally only define those, but for the parts of it where you're doing calculation or dealing with trickier issues like frequently asked question style issues, like how do I do this thing that isn't explicitly described, the publications and the regulations that are issued by the government are a far more helpful resource. If you are curious about the statutory text, Cornell Law has a copy of the United States Code as well as the Code of Federal Regulations, and this obviously includes the Internal Revenue Code, and it can be found at the link that you see that should be clickable in the material, which you either downloaded or have access to download if you're watching this pre-recorded, or if you're attending this live, is over there on the side in the handout section in both a full slide per page readability and 3 slides per page notes-taking format. Now, in a sense, there are two principal forms for deductions: adjustments to income and deductions, and both of them have a different application. Now, adjustments are deductions, but their purpose is to reduce gross income to arrive at adjusted gross income, or AGI. So gross meaning the total value of the income. So everything before it's subject to tax that is includable in the collection of income that can be taxed, gross income, gets adjusted down to adjusted gross income. Not everybody has adjustments, but there are a lot of common ones, and without having the exact specific figures from data collection sources at the IRS, I wouldn't be able to give you a good idea that wasn't anecdotal, but it is common for me during a normal tax season day with support to deal with probably several dozen returns personally that have at least one of them. And in order to do this, these adjustments are totaled on something known as the Schedule 1. The Schedule 1 is something that we referenced earlier in this series for other forms of income, but it also collects adjustments. The page 1 is for the other income, and page 2 is for adjustments. The collection of those values from each page are carried over to the Form 1040 series returns, and the adjustments get carried over to Form 1040 line 10. Now, this is using the line numbers from the most recently available Form 1040 form series. As of right now, there are no draft forms and there are no listed changes to the upcoming year, which have been currently published at the time that we're doing this webinar. Adjustments are statutorily defined, in other words, defined by statute or law, forms of deductions which fit into a number of specific categories. Traditionally, these were known as above-the-line deductions because of their placement on the return. Before the redux of the Form 1040 series into a Form 1040 pared down with supplementary schedules, the original long-form Form 1040 had a dividing line, or a separation, if you will, between the front and the back. The front handled income and adjustments, and then the back handled the taxable income and tax calculation, and the adjustments were placed above the line in that regard. Now, they're still technically placed above the line because they get carried over to Form 1040 line 10, but it isn't quite as much of the same type of division as it was earlier in the pre-2018 version of the Form 1040 series forms. Now, different versions of Form 1040 series forms have historically allowed for different kinds of adjustments, but those systems have all been surpassed by the adoption of the Schedule 1 as the system for reporting additional income and adjustments. Some of the most prominent examples include educator expense deductions, student loan interest payment deductions, self-employment taxes paid deductions, IRA deductions, and out-of-pocket expenses for certain types of employees, or for moving expenses for armed forces taxpayers. We'll go into more detail over what those specific examples apply to, but those are probably the most common ones. I used to do this with an example of those earlier 1040 series placement schemas, but it is at this point so far removed from that time frame. It has, believe it or not, it'll be 6 years that the new 1040 series has been in play, which is far longer than the allowable amount of time for doing amendments to a return to claim refunds, which is 2 years electronically and then up to 3 years back by paper. The first up is educator expenses. Taxpayers who are eligible educators can take up to $300, and that is the tax year 2024 inflationary value figure, which has not increased for this year. I will try whenever possible to show increases and decreases to values by using color coding. Anyway, eligible educators can take up to $300 each as an adjustment to income for unreimbursed expenses that are paid or incurred during the year. Those expenses need to have been paid for use in the classroom or otherwise deductible as a trade or business expense. Now, we don't have unreimbursed employee-related business expenses in general for most people anymore, but just imagine that if a person's job to the general market was to be a teacher, and they were doing so as a sole proprietor, would those expenses meet the qualifications for deducting them as a trade or business expense? Would they be treated as necessary and ordinary expenses? And if they paid for them out of pocket and they were not reimbursed for it, then they are eligible, assuming that they're an eligible educator, to take this adjustment to income. Now, because of that loss of the unreimbursed employee-related business expense deductions, because of the TCJA changes, remainders over that $300 value are lost and are not eligible to be deducted. And this is not a per return, it is a per taxpayer. So if you had two taxpayers who were filing jointly and they were both teachers, the potential maximum is $600. And when we're talking about eligible educators, we include teachers, counselors, instructors, principals, and aides, or their equivalent in grades K through 12, so in kindergarten, primary, secondary school, and any other individuals who work at least 900 hours a year in a school which provides elementary or secondary education. Now, these expenses can only be deducted to the extent that they exceed certain values. Any exclusions of Series EE and I savings bond interest that are used to pay for qualified tuition, any distributions from qualified tuition programs that are excluded from income, or by extension, tax-free withdrawals from covered ESAs, or any reimbursed expenses that are not listed in Box 1 of Forms W-2. And that goes without saying. If you're paying out of pocket and you're being reimbursed for it, and they're equal to one another, generally that fits the qualifications of an accountable plan, and it is not income to the taxpayer, and it is treated as a business deduction for their boss. But if for whatever reason they had educator expenses and they were reimbursed, they obviously cannot take a deduction for those costs if they were reimbursed. And likewise, the rest of it is essentially if they are gaining a tax-free benefit and excluding some kind of income, whether it's withdrawals from a covered ESA, distributions from a QTP, or excluding that savings bond interest, if they are getting a tax-free treatment of what should normally be reported as income to pay for school, the expenses that they are able to deduct must exceed that value. This has a lot of interplay with any of the college expenses that are used for the education credits. Very similar approach here. In either case, assuming that all that's true, and it probably won't be an issue unless you have a very new teacher who is perhaps still in school and having to deal with distributions, etc., then this adjustment gets reported on the Schedule 1, line 11, and then, of course, flows down to Form 1040, line 10, after totaling on the Schedule 1, line 26, with all of the other adjustments to income that are present on the schedule. Next up, we have unreimbursed expenses. Now, you heard me say earlier that they were gone. Well, they are. They are gone because we're talking about those as an itemized deduction, which is where they are no longer present. However, there have always been unreimbursed expenses that exist above the line for certain categories of certain types of employees, and those individuals still have the ability to deduct in the same manner as before because they are not treated as the itemized deduction equivalent, which is known as a 2% floor deduction, which we'll talk about in a little while. And the only expenses that can be used for this are the expenses for qualified reservists, fee basis government officials, and qualified performing artists. Those individuals take their unreimbursed employee-related business expenses as an adjustment instead of treating them as an itemized deduction, and they use the same form that used to connect to the pre-TCJA Schedule A line 21, the 2106, which is the same thing for the unreimbursed expenses form. Calculate those up and then report those expenses on the Schedule 1, line 12. These are very rare to see on the return. So don't make the mistake of trying to use pre-TCJA rules for other type of workers. And if you need more information, I would take a look at publication 463 because that is the guide for a lot of these types of expenses that you're going to be using for this purpose. That publication 463 contains the specific rules for each one of these in more detail, like the qualified reservists being on active duty, more than 100 miles from home, being able to take their travel and lodging expenses, etc. The fee basis government officials and how that works, qualified performing artists, having their income limitations, I believe it's $16,000 per year, but having expenses because they work for at least 2 or more employers. Like I said, highly specific types of deductions and very rare. But in either case, 2106 to the Schedule 1, line 12, and then afterwards, subsequently, into the 1040 itself as an adjustment. Next up, we have HSA deductions. Now, taxpayers who contribute to a health savings account or an HSA can potentially take deductions for their contributions that have been made into that plan during the year. They have to complete and attach the Form 8889, and then the amounts that are deductible go over onto the Schedule 1, line 13. The amount itself is limited to either an inflation-adjusted value of $4,150 for self-only coverage or $8,300 for family coverage, and this is using tax year 2024 values. There is a $1,000 catch-up contribution figure allowed if the taxpayer is age 55 or older. Any contributions in excess of that figure are charged a 6% additional tax on the excess, and the contributions themselves are usually reported to the taxpayer on a Form 5498 SA. This is a good time to point out that you are going to see this often on the W-2 in the box 12 value, because you get the 4 slots, boxes 12A, B, C, and D, with a code W and an amount. And in most commercially available software, including the one that we use, it just carries over from the W-2 over to the 8889, which you then have to complete. But even if it doesn't, you want to make sure that if you're looking at that 5498 SA, which they should be receiving, that 5498 SA will show their contributions. You want to make sure that you are not deducting them twice, because if they are on the W-2 in box 12 with a code W, then they have already been removed from the box 1 value. You would notice, for instance, if you had $2,000, for instance, into an HSA, that your box 1 wages on the W-2 are going to be $2,000 at least less than the Social Security and the Medicare equivalent, because they allow you to make those deductions and get tax-free treatment for federal tax purposes, but not for the purposes of Social Security and Medicare. In fact, many of the things that can go on a W-2 that reduce the box 1 value will not impact the boxes 3 and 5 Social Security and Medicare tax values at all, which have not only a lower tax rate, but will be completely unaffected, generally speaking. So if you do get that 5498, and it tends to come in tandem with the 1099 SA, showing the amount, if any, of the distributions they had taken out for medical purposes during that year, then you'll be able to see and match that up. If you look at a 5498 SA and the value is larger than what is on the code W on the W-2 in that box 12 value, you can take that excess as a deduction. And likewise, you'll be able to see that distribution and use that to complete the 8089 itself down there on lines 14 to show how much the distribution itself was for a qualified medical purpose. All right, we're about 20 minutes into it, so we're going to go ahead and stop this webinar for a second in order to bring up our first polling question, or if you were watching this pre-recorded, our first interactive review question. Now, if you're watching this live, all you have to do is answer the polling question. The polling questions are simply participatory. Don't check any of the answers or even really care if they're answered correctly. It's just trivia, and its intention is to see that you are here for a majority of the time that we are allotted to talk about the topics. Otherwise, if you are watching this pre-recorded, you will have a review question that you will have to pass in order to continue with the rest of the presentation. You can click as many options as you need to. Once you have successfully answered it, you will be able to continue. You must get through all of them in order to mark this course as complete and allow the review exam for those individuals who are taking this as a standalone, or to mark it as complete in your progress through a larger course set if you are, for instance, doing the California CTEC 60 qualifying education. Attempts to circumvent the system involves a revocation of the credits or the absence of reporting them. And if you are not watching this, at least on our website, federaldirecttax.com or preparetraining.com, in our browser with the appropriate window, you will not have the question framework. If the video keeps going without a question, then it is not being done correctly, and you will not be able to mark it as complete for you to be able to go through it. And now with that, I'm going to go ahead and stop the recording process so I can pop that first polling question up, and then we will touch base after that first polling question is done. All right, back from that polling question, and I don't see in the questions panel over there on the side that we're having any technical issues. Remember, if you are having technical issues, then you would need to contact our support, because when we're doing these live recordings, there is very little that I can do technically on any one specific person's computer. That being said, moving expenses. Moving expenses, there's a lot of red on this page. It says pre-act with a little asterisk. And the reason why is that from 2018 until the end of 2025, this has been repealed for almost all taxpayers. It used to be that you would be able to do this for anybody who moved in order to work or moved a certain amount of distance and then did so and then worked immediately afterwards. But now it exists in a highly limited circumstance, primarily for military members. I'm going to tell you the rules as they apply, and as they apply to military members, kind of, because they sort of get a free pass at the distance and time working tests. But I do want to keep the information in there from the pre-act treatment, primarily because a lot of states are not conformal to the IRC with this, to the current version of the IRC, and do allow moving expenses at the state level following the IRC's original rules for it. So, starting off with that, and keeping in mind that this doesn't apply at the federal level except for military people, taxpayers who move for work-related purposes can potentially take their moving expenses as an adjustment to income on the Schedule 1, line 14. It requires the completion and attachment of something known as the Form 3903. The move distance needs to be 50 miles further than the old commute distance. So that is an important distinction. I have actually seen it challenged and successfully defeated in audit, because even though they moved very far away, they actually moved closer to their job where they were going to, and the amount of the move was not bigger than the amount of their commute distance by 50 miles, because that's the way that it works. How long does it take you to get from old house to old job? Add 50 miles, move that far away. It needs to be at least that big. And the move needs to also be related to the start of new employment, both in time and place. Military exceptions exist, and those are the only ones that actually allow this to continue existing. Now, moves are generally close in place if the new commute isn't much more than the old commute. And in order to be close in time, the taxpayer needs to work 39 weeks during the first 12 months of the year as an employee, or 39 weeks during the first 12 months and then 78 weeks in the first 24 months if they are a self-employed individual, or some combination of those. There are exceptions for death, disability, involuntary separation, and so on in regards to the close in time test. And that working thing is forward-looking. Technically speaking, if somebody claimed these and then moved and then did not satisfy the conditions, they would be personally bound to having a need to file an amendment to correct it. Now, unless the IRS happens to learn otherwise, nobody is really going to do that. I'm not saying that you shouldn't recommend it. As always, duty to advise. Tell the client, oh, hey, you didn't pass these tests in this scenario where these still existed, right? You didn't pass these tests, and we deducted this in a previous year. We need to go back and amend it. You don't need to make that conditional on your current filing unless it has a direct impact on something that matters for your filing at this particular moment, but advising them that they need to do it and advising them of the consequences for non-compliance is part of the duty to advise. Now, these expenses, of course, cannot be claimed if they're reimbursed by a third party like an employer. Unless the taxpayer is a military taxpayer, any reimbursements that they get for moving whatsoever must be included in full in income for the year. And generally, they are. They're just already wrapped up into the W-2s that the employee gets at the end of the year. Now, like I said, this only exists in tax years 2018 to 2025 for active duty members of the armed forces who have to move on official orders to a new duty post like those under PCS or PCOS orders. And the standard mileage rate for moving expenses for tax year 2024, it actually drops a cent this year, is 21 cents per mile. And like I said before, some states still have this as an adjustment at the state level, most notably California and New York. Next up, we have one of the greatest boogeymen in tax preparation, especially for new preparers, self-employment tax. Most people don't think about it until they have to deal with it for the first time, or they have self-employment taxes that they've paid on their own returns. Self-employment tax that is calculated on their return comes from self-employment activity. Schedule C, Schedule F, 1065 K1s. Those are the Schedule K1s from the 1065 partnerships and so on. What happens is you pay your self-employment tax, and then half of that amount is taken as an adjustment to income. This is probably one of the most common forms of adjustments that will apply. Self-employment income is present on, depending on the year, somewhere between 10 to 15% of the average person's return, and in some areas it might be even higher, especially areas where you are servicing a market that maybe caters towards certain types of self-employment activity. Immigrant markets is a really common one I can think of for people that run food trucks, lawn care services, and so on, or immigrant-based services where they are operating as sole proprietorships and so on. Now, the tax itself is calculated on what is called the Schedule SE. The Schedule SE is required to be attached to the tax return, and that is added to the taxpayer's total tax liability as an other tax. And this is why it becomes the boogeyman, because you will have people who are filing self-employment income for the first time, and they're wondering why their refunds are different, why they're smaller, or why they're having to pay more, because they are not aware of the fact that what is happening to them is the same thing that happens when they get paychecks from their bosses when they're not self-employed, only they never have to see the money before they get rid of it. Because the self-employment tax is the self-employed equivalent of the FICA taxes. The SECA tax, or the Self-Employment Contributions Act, makes you take the same amount out. But because the self-employed individual is the employer of the self, they also have to pay the employer's portion, but it becomes a business expense in that regard. But rather than having them deduct that expense on the business return, like a Schedule C or something, then it just is taken, the employer's portion, quote, is taken from the income as an adjustment. So half the self-employment tax is taken on Schedule 1, line 15, and reduces the amount of overall income subject to tax. It doesn't reduce the self-employment taxable income. So if I had a $10,000 Schedule C, I'm going to pay self-employment tax on $10,000. But on the personal side of things, I'm going to take whatever that value is, half of that self-employment tax. So I'm going to take $10,000 of ordinary income minus that value and then pay the taxes on that. And this, of course, doesn't consider things like your standard deduction or itemized deductions that are going to reduce that even further to get to that point. But you see what I'm saying. Half of that self-employment tax adjustment to income. Likewise, contributions to retirement plans for self-employed individuals. If you are self-employed or have a self-employed taxpayer and they contribute to a SEP, a simple or a qualified retirement plan or a QRP, they can take their contributions on the Schedule 1, line 16 as an adjustment to income. Now, the calculation of the allowable contribution amounts can be very complex because most things involving retirement plans are somewhat complex. Fortunately, most commercially available software platforms do have worksheets. If they're of any value at all to you, they'll have worksheets that are in the software. You can also see Publication 560, and I would say for self-employed ministers, you should check out Publication 517. Continuing on the same thread of self-employment related adjustments to income, self-employment health insurance amounts can also be deducted as an adjustment to income. Those taxpayers who are self-employed or who are considered self-employed and who have health insurance costs can deduct those amounts for themselves, their spouse, or their dependents, and it also covers payments made for children under the age of 27. Since they're allowed to stay on their parents' insurance plans until they're age 26, they can use those costs as well for the basis of this, even if that dependent, or sorry, even if that person is filing their own return and is not a dependent. This is entirely capable of being used on those people who are on the plan, and it doesn't matter whether it's a plan through the name of the business or not in most cases. It doesn't matter whether it's a person paying for the out-of-pocket costs into certain types of premiums for other types of insurance, like government-based ones. It doesn't really matter. All that really matters is that they have health insurance costs and they're self-employed, and they follow the calculations appropriately, that it gets placed on the Schedule 1, line 17 as an adjustment to income. Publication 535 contains more information, and you can also use Publication 974 if the taxpayer's plan was through the marketplace and they're also claiming the premium tax credit as a consequence, in which case there's going to be limitations on the amount of the amount that can be taken as a payment if you're getting a credit in compensation. So you'd be probably balancing them out and then removing the amount that's paid for the credit and only the part that's actually considered paid for by the taxpayer as eligible. Early interest and alimony. If you have a taxpayer who's penalized for early withdrawal of their savings, and they have reported penalties that are listed on Forms 1099 INT or 1099 OID, those penalties will be taken on the Schedule 1, line 18. There doesn't really need to be much more of a description for this. If they have a 1099 INT or OID and it shows a early withdrawal penalty, then that amount just gets placed right there on the Schedule 1, line 18. This is very rare. Taxpayers who pay out alimony and can deduct their alimony will do so on the Schedule 1, line 19A. And if you need more information on it, see the tax topic 452 or Publication 504. Alimony, by the way, doesn't include child support, non-cash payments, payments from community property income, or payments that are made to keep up an excess property. The long and short about it is that alimony, as a general rule, is not deductible and is not includable in the income for the recipient for any of those instruments that were signed and made legal from January 1st of 2019 onward, or that were modified after January 1st of 2019 in order to specifically take advantage of the TCJA changes. However, people who had divorce and separation decrees that have alimony baked into them that precede the 2019 starting point and which are not modified afterwards to specifically exempt it are still going to be on the return, both as income or in the case of the payor as a deduction, an adjustment to income. If you have contributions to a traditional IRA or a trad IRA, those get reported on the Schedule 1, line 20. Now, unlike earlier years, there's no longer an age limit to making contributions and taking the deductions on the return. A lot of changes to retirement plans have been basically pushed down through the passage of Secure Act and Secure Act 2.0. I do have an entire presentation in the tax law updates category if you want more information on it. Taxpayers cannot deduct IRA contributions if they were to a Roth IRA. The Roth is the inverse of the traditional IRA. You take a deduction on an IRA now, get tax savings now, pay taxes later when you pull it out. With a Roth, you don't get any tax benefit now, and when you pull it out, you get either tax-free distributions to some degree or lesser taxed amounts because of getting your basis taken back. You also cannot take an IRA deduction if they were elective deferrals to a 401k, 403b plan, Section 457 plan, simple plan, or payments made over to the Federal Thrift Savings Plan, or TSP. You can find more information inside publication 590A. And if you have contributions to these plans, you may have a taxpayer that qualifies for the retirement savings contribution credit. That is not going to be around for very long because they're going to be replacing it with the Savers Match, where the government will do matching payments into retirement plans instead of having a credit on the tax return. So this will be one of the last opportunities that you have in order for that credit to qualify. I know in our software, it automatically comes up if you have contributions. It's kind of always checking to see if it's valid, but that is something that you can do if you have IRA contributions that are made. There's also student loan interest payments that can be deducted. Student loan interest payments are reported on the Schedule 1, line 21, and a maximum per return adjustment value of $2,500. Can't do this if the taxpayer is married filing separate or considered a dependent of another. So that's kind of a common theme. We had the dependents webinar last week, I believe, and then the filing status one before that. Taxpayers that are dependent of another person really lose access to much of the special tax stuff. Now, student loan interest payments that are deductible are subject to a modified adjusted gross income phase out, where it gradually reduces the amount of the deduction down to $0 afterwards, where it can't be claimed. And that happens for joint filers once their MAGI hits $150,000 and finalizes by $180,000. And for all other filers, it happens from $75,000 up to $90,000. Taxpayers get Forms 1098E to report the interest paid. And you can also see the publication 970, which is the education publication, or tax topic 456, which links to an IRS site on tax topic 456 covering student loan interest payments received or made and then deducted. We also have Archer MSA contributions. Those taxpayers who pay into Archer MSAs, either from their own contributions, from their employer's contributions, or a combination of both, can take deductions on the Schedule 1, line 23. Now, these Archer MSAs are basically functionally similar to and kind of like predecessors to the HSAs, which have largely supplanted them among many of the other things that exist for health savings accounts or their equivalent. Congress stopped the creation of all new Archer MSAs in 2007, and most taxpayers have since stopped using them or migrated, or the companies that had them migrated over. Those individuals who still have Archer MSAs and whose plans are continuing to exist are just and grandfathered over even despite the post 2007 cutoff, can continue to use them as they are grandfathered. And in order to do it, they complete and attach Form 8853 to the return. To date, I have only done this a handful of times, very uncommon, but it does still technically exist. And there's also a whole bunch of other adjustments that can be taken on the Schedule 1, line 7 or 24 subcategories. They're listed by number and by letter. 24A, jury duty pay. If a taxpayer gets paid their salary by their boss and their employer requires them to turn over their salary or their jury duty payments because of that, they would be able to take that there. This is an uncommon thing. But if you have somebody, for instance, who's still getting their paycheck even though they're on jury duty and the boss makes them give the jury duty money over to them to defray the cost of having them out and paying their salary for the jury duty, then you can deduct it there. If you have line 8L income on the front of the Schedule 1, which is the income from non-business rental of personal property to others. So you have an individual who is making money by renting personal property to someone, but they're not operating it as a trade or business. This is, like one-off, letting somebody rent something of yours. You're not treating it like an actual business activity and offering services to the market, and you have some expenses. You can use this line to defray that cost. Line 24C is for non-taxable Olympic, Paralympic, and USOC prizes, where you would basically back the cost off. So you get a prize, it gets reported to you on the return and goes on the return, and then you back it off and basically take it away here. 24D, reforestation, amortization, and expenses. You got amortization and expenses related to reforestation. That's going to go there. 24E, repayments for any supplemental unemployment benefits that are under the Trade Act of 1974. 24F, contributions to Section 501c18D pensions. 24G, contributions by certain chaplains to Section 403B. 24H, attorney fees and court costs for unlawful discrimination claims. If you have any income from the unlawful discrimination, you can back off the attorney's fees and court costs for it. If you have somebody who has an IRS whistleblower award, you can also deduct the attorney fees and court costs connected to that under 24I. Any housing deductions that are carried over from Forms 2555 for those people who are doing housing deductions instead of just the foreign earned income exclusion on the same form. It goes on 24J. If you have any excess Section 67E expenses that are carrying through from Schedules K1 that come from a 1041 estate or trust, they're going to go on 24K. And then 24Z is going to be for any other adjustment. That can be for anything else with a legal basis that isn't listed above. Anything from like misreported income forms, 1099s, 1099Ks. A perfect example, 1099K, the merchant and third-party merchant collection for people who are doing online commerce. Maybe they get a 1099K that shows that they received money because they're, paying and receiving money on Venmo or PayPal or something, but it turns out they're not operating a business. Maybe they're sharing and splitting the cost of going out to dinner with friends. And, one person covers a bill one time, another person covers it another time, or beer money for a party or a get together on a holiday. It doesn't really matter what it is. The person gets a 1099K and it's reported. Stick it on the return, back it off by making it non-taxable, and then just keep copies of the records. So if the taxpayer needs to explain to the IRS, they can show the basis for why they did so. But that's what 24Z is for. It's the everything that isn't explicitly listed above option. All right, we're going to go ahead and pop up another polling question or give you guys another interactive review question. You know the drill by now, so I'm going to go ahead and just get to it so as to not make this take longer than it needs to. All right, 1 second. All right, so now we're going to talk about standard versus itemized deductions. And pretty much after this, the rest of the presentation is going to be dealing with itemization as a concept. After the AGI is calculated, your adjusted gross income, what's going to happen is that either the standard or itemized deductions, whichever one your taxpayer chooses to use or in some cases is required to use, will be used to then reduce AGI to arrive at taxable income, or the income that is subject to the ordinary income tax. These types of deductions are known as below-the-line deductions since they fall below the income versus tax calculation line that we were talking about earlier with the pre-TCJA format of the 1040 series forms. Now, every taxpayer qualifies for the standard deduction unless they're specifically prevented by law. That's from IRC Section 63C, which has a married filing separate exception. And the standard deduction amounts themselves are defined by statute and are based on the filing status, the age, and the presence, if any, of legal blindness. And speaking of that married filing separate exception, we'll talk about that basically after the third polling question when we get into discussing itemized deductions more specifically. Now, itemized deductions are calculated on a per return basis with a certain specific personal expenses and mathematical formulas combining together to create a total figure. So your itemized deductions take advantage of specific types of expenses. And so you're looking at taxes that you pay, both in terms of real estate property taxes and the taxes that you pay as income tax to the state of residence for those states that have state income taxes. You're looking at the cost of mortgage interest being paid, and a whole host of others. Now, if your standard deduction value compared to your itemized deduction total turns out that the itemized deduction is larger, then the taxpayer can itemize their return and reduce their taxable income further, because everybody gets a standard deduction value. Like I said, it's a flat figure. It's defined by statute. It's an annually adjusted inflationary value that just is tied to your filing status, age, and blindness. And that's pretty much it. Whatever that filing status is, whatever the age is, you just put them together, combine them. That's the total. It gets subtracted from AGI, taxable income afterwards, is right there. Itemized deductions, more specific, per return basis. In 1 year in particular, you might have an individual who pays a lot in state income taxes or has a lot of personal property tax applied to their residence and or maybe vehicles or a large purchase, and they take the itemized deductions 1 year and then don't again for another 10. It's highly situational. Now, most commonly, your taxpayers who are going to itemize are probably going to be high AGI clients or homeowners, probably both. It can also apply to those who make heavy amounts of charitable contribution to either churches or other tax-exempt entities, etc. And as of right now, we're looking at less than a third, and this figure is declining, of taxpayers are itemizing. And part of this is because the changes to the TCJA essentially doubled the size of the standard deduction and got rid of the personal exemptions. Also got rid of your phase outs for both personal exemptions and phase outs and limitations for AGI. But in either case, that doubled value or roughly doubled value has made it so that way many people are no longer itemizing who traditionally would have been up to this point. Now, we're just going to talk about a slight bit of historical background. Itemized deductions have basically existed in some form or another throughout the course of the income tax's history. So, in its totality and in its current form, to some degree, a little bit over 110 years as of right now. Each has its own complex history, being introduced, removed, brought back, raised, lowered, capped, fixed excess of percent ratios, and so on. And then they're based on two primary principles: the return of capital or operating expenses and the autonomy of state revenue structures when compared to their federal equivalents. Now, the standard deduction itself was introduced in 1944 when the total percentage of Americans paying taxes increased to about 70% of the working population, which was also being done towards the end of World War II. And originally, it was a 10% of taxable income figure capped to $500 for a single filer and $1,000 for joint filers. The adoption of this policy, by the way, almost immediately set off conflict with religious organizations and charities because they didn't want to have to pay withholding over to the government at the time, which is pretty much the exact same tactic that happened when they introduced withholding from paychecks the immediately preceding year in 1943. This changed from a calculated percentage value to a flat value figure in 1964, which was temporarily renamed the Low Income Allowance, and it was updated again in 1986 under the Reagan Tax Reform Act to be some version of its current form. The TCJA that passed at the end of 2017 once again reformed the standard deduction as well as itemization, primarily covering sections IRC Section 63C7. The standard deduction values, as I mentioned before, were basically doubled, and itemized deductions became heavily restricted or completely eliminated as an option for a large number of taxpayers, and that includes things like them removing the 2% of AGI miscellaneous deductions and changing the value in such a way as to make it basically out of the reach of most people. All right, the standard deductions themselves are, as I mentioned before, inflationary, which means that they're indexed to inflation. And unless we have a deflationary year, they will basically increase in value year on year. And they change typically on an annual basis. So far, they've increased every single year that I've been doing this. Now, for tax year 2024, the amounts of the standard deduction are, as based on filing status, for joint and qualifying surviving spouse filers, 29,200. For head of household filers, it is 21,900, and for single or married filing separately filers, it is $14,600. Now, every taxpayer who is either age 65 as of January 1st of the year following or who is legally blind gets an additional standard deduction, and that amount is going to be different based on their filing status. For a single or head of household filer, for each one of those that applies, they will add an additional 1,950, and for all other filers, they will add an additional 1,550. And if you have attended or seen the filing statuses and requirements webinar, you'll know that the age for the tax year is based on what age you turn during the year or January 1st of the immediately following year. So for tax year 2024, if you have an individual who turns 65 on January 1st of 2025, they are going to be age 65 for the entire preceding year. Now, taxpayers who file as the dependent of another, and once again, cover this in that other webinar, but if you are coming into this, for instance, this is your first live webinar, if there is no requirement for a dependent to not file, there's no minimum age. Dependents can totally file their own returns. The the consequence of that, I guess I should say, is that they don't get to claim the right to their own exemption and they don't get tax benefits like credits and so on. However, they can still file their tax return. It's not an uncommon thing for dependents of another to have, for instance, a summer job or do anything like self-employment, maybe a little yard hustle or something similar to that, where they're going around and operating themselves as a sole proprietorship. In either case, they also get a standard deduction value, and just like anybody else in the code. And for those dependents who are filing a return, they have one of two numbers: the greater of either $1,300, 1,300, or whatever their earned income is plus $400. Now, this value is limited to whatever amount they would have been able to claim if they had filed on their own without being considered a dependent. In other words, the standard deduction value that applies to their filing status is the upper limit. They don't get earned income plus $400 indefinitely. That would basically make them incapable of ever paying tax. So they have one of the two numbers, $1,300 or earned income plus $400, and that gives them a standard deduction, for instance, of $1,300 if the only income that they have is considered unearned in nature. Interest, dividends, cap gains, capital gain distributions, income from intangible property, investments, whatever, of any kind. Or if they're working, they get a $400 addition to whatever their earned income value is, which is coincidentally also the same minimum value of self-employment income that triggers a requirement to file. And then that goes up to the amount of whatever the filing status would be for their particular, or the standard deduction for their filing status, as if they were not the dependent of another. Earned income in this sense, by the way, is the same as it is treated in all other areas of the code. It includes income earned by offering personal services as an employee, a common law employee, statutory non-employee, sole proprietor, an individual operating a sole member LLC as a disregarded entity, salaries, compensation, tips, and essentially anything where you are offering services and receiving income because of either those personal services as an employee of another, trade or business activity, and so on. It's fairly intuitive, but just so that way we're clear, we are talking about working in some sense to get money, or at least on paper working to get money. And we are not talking about interest, dividends, cap gains, investment income, pensions, annuities, gifts, devices, inheritances, bequests, operating pass-through, passive activity, income-based entities, rental and royalty income, and so on. Standard deduction value, by the way, as well, is also used to form the basis of the filing requirement thresholds. And outside of certain types of income or credits, as in other requirements, like you have generated specific types of taxes or have certain types of income that must be reported. Generally speaking, gross income over the standard deduction value is what triggers a requirement to file a return. If you need to have a refresher on that, that's the one that we did a couple weeks ago. It should be available on the portal if you were not able to attend. Those filing requirement thresholds, like I said, being based on the standard deduction, are essentially going to be one value equal to the standard deduction, and then the increase, the minimum increase based on the individual's age being 65 or older. So for a single filer, you are looking at a $14,600 gross income threshold, or a $16,550 threshold if they're age 65 or older. Head of household is $21,900 and $23,850 respectively. Married filing jointly is going to be $29,200, and then if one spouse is age 65 or older, $30,750, and if both are, $32,300. Married filing separately, on the other hand, does not get the benefit of the standard deduction in the gross income calculation for the filing requirement threshold. They are required to file a tax return the moment they have $5 or greater in gross income, regardless of any other extenuating circumstances or exigent circumstances. Qualifying surviving spouse, on the other hand, is going to be basically functionally equivalent to married filing joint, but considering only one individual. So $29,200 for the baseline, and then $30,750 if that surviving spouse is age 65 or older. All right, we're going to go ahead and do another polling question. So it's going to pop up on your screen, and we will go ahead and get that taken care of and continue on. All right, now we're going to go ahead and talk about some myths connected to itemized deductions. Deductions are dollar for dollar credits towards tax liability. Claiming deductions gets you a full reimbursement of the original costs at the end of the year. Anything that you have a receipt for is a deduction and belongs on the tax return. Living expenses like food and utilities are deductible. Special needs, elderly dependent, social security, disability, and so on all let you take more deductions. And basically, pretty much 2-1, every one of those is wrong. First one is deductions are a dollar for dollar credit towards tax liability. Well, if that was the case, then they would be credits and not deductions, because itemized deductions offset taxable income, which results in a percentage effect, which is based on the marginal tax rate. The marginal tax rate being what's the tax rate of the money that you're earning at the end of your current income band. So 22% tax rate, as an example, which is commonly where most joint income households will end up being, would have 22 cents on the dollar, which means that to get $1 of impact on the taxes directly as an equivalent value and not just rounded up to $1, that you would need to have 4.55 times the amount. So for every $1 of tax credit, you would need to, in order to make it equivalent, have to spend $4.55 in a deduction to have that same impact. That obviously gets more extreme the further you move along in the income bands, but overall, tax credits directly offset tax liability dollar for dollar and are more impactful in that regard. Next one, claiming deductions gets you a full reimbursement of the original cost at the end of the year. Well, once again, that would make them a credit. If what you did was got your money back exactly, that would be a credit, and a pretty favorable one, considering that most credits that do exist, the good ones, are generally speaking only somewhere in the realm of 15 to 30% of whatever it is that the expense is based off of. Claiming deductions can only offset the taxable income. Now, that offset may result in a person receiving a larger portion of unused withholdings and potentially refundable credits if you have a reduction in the tax that's calculated. Because remember, they're opposed to one another. You have tax being calculated, and then on the other side, you have payments, withholdings, and credits. And they offset one another. If you don't have enough, you owe money. If you have more, you get the excess as a refund, or can be potentially put to estimated taxes or put onto next year's tax bill, etc. But you don't get a full reimbursement. It's not having your rent on the tax return means that you get your rent back at the end of the year. Next myth: anything that you have a receipt for is a deduction and belongs on the tax return. Only expenses that are prescribed by statutes are eligible for deductions. However, if you do have a client that is in the habit of keeping receipts for things, I'd say encourage that behavior, especially if they do get involved in itemizing and they need to have justification for deductions because the IRS does send a letter requesting it, or they, unfortunately maybe wind up in an audit, or if they're operating a business activity or some other kind of income producing activity, keeping receipts is a very good habit to have. It doesn't, however, automatically generate any kind of necessary tax implications just because a person has proof of something that they paid for. Next myth: living expenses are deductible. Living expenses are not deductible on the federal level. They may be deductible on the state level, or more importantly, some living expenses may be treated with special provisions at the state level, usually in the form of credits. Commonly, for instance, in the Midwest, there are provisions in many states for credit based on heating, property tax credits, or pass-through rent credits that allow individuals to basically get some percentage of the benefit of having paid property taxes by proxy by getting to take their rental expenses. And it's not something that is consistent enough that I could give you a precise example of every single rent credit, property tax kicker, circuit breaker, or anything else that you would be able to find at a state level. But keep in mind that the living expenses may have a state impact. Federal level, though, there is no direct impact if it's not directly related to business activity or otherwise allowed by law as a deduction. Next, special needs, elderly, dependent, Social Security, disability, etc. all let you take more deductions. Everyone is treated equally in the eyes of the law when itemizing. Now, that being said, special needs, elderly, dependent, Social Security, disability, these types of individuals may have more medical costs. Medical costs are itemizable if they exceed certain thresholds. And in that sense, perhaps somebody who's coming up with this myth is thinking of the likelihood of having certain categories of expenses at a greater value than somebody who is not in an equivalent medical situation. But just because somebody is special needs, elderly, dependent, on disability, doesn't necessarily mean that they can take more deductions by fiat. Now, like I said before, itemized deductions offset taxable income, and that results in a percentage effect based on your marginal tax rate. So whatever your marginal tax rate is, or the highest rate of tax that you are currently paying on your income, every dollar you spend, you get that much of a cent-based amount. 10%, you get 10 cents on the dollar. 12%, 12 cents on the dollar, etc. And the itemized deductions themselves consist of a collection of certain expenses and amounts that are paid in specific categories, and they are calculated on the Schedule A, which is attached to the Form 1040 or the Form 1040 SR, which the Form 1040 SR, in case this is the first time you've heard it, is a slightly simplified version of the Form 1040 designed for senior citizens. Itemized deductions themselves also used to be limited to high AGI, which were called Pease limitations, and named after Congressman Donald Pease, who originally instituted them back in, I believe, 1994. But that was pre-act law, and the TCJA suspends those from tax year 2018 through tax year 2025, but they are present with some state returns, notably since a lot of the content we make is in connection to the California CTEC 60 qualifying education course. California, for instance, has limitations that are applied to itemized deductions to reduce them because of this. Now, itemized deductions are only beneficial if they are greater than the allowed standard deduction. I mean, technically, you could complete a return and force itemized deductions to apply when it would be harmful to the taxpayer. I've actually seen individuals do this specifically because they were in they were separating with their spouse and they wanted to do anything that they could, I guess. But you could do that, but generally speaking, software is going to automatically apply whichever has the greater tax effect, which greater tax effect in this case means that they're going to be paying less tax overall. Okay, obviously every situation is different. It may or may not be beneficial to individual taxpayers in one situation or another to pay more or less tax based on whatever reasoning and legal situation justifies it. But itemized deductions are only beneficial in the general sense if the amount of tax savings is greater than just taking the standard. Married or taxpayers who are filing separately need to match deduction stratagems. If one itemizes, so must the other. This is the married filing separate exception I was talking about earlier. Now, this applies even if it hurts the taxpayer and unless the spouse is treated as abandoned and otherwise is eligible to file as head of household. So there are exceptions to filing statuses. Generally, if you are married at the end of the year legally, you need to file as one of the married filing, or married separate status, or married statuses, I mean. Married filing jointly, married filing separately. Married filing separately, for most cases, is horrible. I know they've changed it to allow exception to some of the credits that used to be just blocked. There are exceptions for earned income credit for married filing separate filers that were put in place by ARPA and all the other COVID-related legislation that came out. But generally speaking, married filing separate has a lot of negativity attached to it and loss of certain types of tax privileges. And if the other spouse can qualify as considered unmarried, file head of household, or some other situation where they are not forced to use a married status, then maybe they would be able to get away with it. But otherwise, when you have two filers who are married and one of them itemizes, the other one must do so too, even if it hurts them. And this can result in the IRS basically making adjustments to returns after the fact. People who are going to itemize and cause essentially tax-related harm to the other taxpayer usually are not on a good enough term or terms with that other spouse to reach them in advance and say, hey, I just wanted you to know I'm going to itemize. And how this could hurt the other taxpayers, usually in the situation where one of the spouses has a significantly higher earning potential and or spends more of their money out of pocket and therefore has deductions that the other one will not have. Now, this intersects quite nicely and confusingly with community property treatment if you have individuals living in a community property state. In those cases, if they are in one of those 9 states or they are in a marriage where they've elected to use community property treatment in the 3 additional states that allow it, they might be allocating income and expenses, including deductions, on an 8958 between the two of them, but that's a little bit out of scope. All I'm trying to say is that generally speaking, you need to keep in mind that if you have somebody who is filing separate that doesn't qualify for the exception and one of them potentially does have the ability to itemize, that your client may be forced into it even retroactively by, for instance, getting a letter from the IRS that says, hey, John or Jane Doe, the other half has itemized and we have adjusted your return to reflect the loss of the standard deduction. You can respond to this letter with your own Schedule A to correct these values or accept our corrections. Itemized deductions, by the way, can also make returns more likely to be selected for audit or review, and there are certain audit magnets like excessive charitable contributions, bogus business expenses, etc., primary culprits. Now, business expenses I have on here just to sort of historically remember that unreimbursed employee-related business expenses are no longer deductible for most people in general and are definitely not itemizable at the federal level, but those types of things can generally increase the likelihood that the IRS does reach out to substantiate values. If you have somebody who is on food stamps and raising multiple children, and the income that they have maybe doesn't even generate taxable income or a lot of it, and they're somehow spending 50% of their income every single year on charitable contributions, ratios, that type of thing can definitely draw a letter from the IRS going, hey, can you prove these things? And if so, give us the information that we need. All right, once again, it's time for another friendly neighborhood polling question. So we're going to go ahead and get that popped up on the screen. And then once we have had that up for about a minute, minute and a half, for all you live attendees, we'll go ahead and close it down and continue. Otherwise, answer the interactive review question, and then we will continue after this break. All right, now itemized deductions, since we're going to talk about those in more detail now, they consist of several expenses within the following categories: medical and dental expenses, taxes paid, interest paid, gifts to charity, casualty and theft losses, and other itemized deductions. And those are the categories that are actually outlined on the Schedule A itself. Starting off with medical expenses. In order for medical expenses and dental expenses, by extension, to be deductible, they need to exceed 7.5% of AGI before the excess is deductible. So the Schedule A itself actually has the total amount and then the limit and then the excess over it. So if you made $100,000, for instance, on a tax return and you were itemizing, the medical expenses paid would need to be greater than $7,500 in order to be deductible. So in the case where someone had $8,000 of medical expenses, they would only get to add $500 to their Schedule A total. Now, the costs for this include health, dental, and long-term care premiums, and this is the amount that they actually paid that was not, for instance, paid by another person or covered by some sort of outside third-party cost. Any of the costs that they pay out of pocket for prescriptions, costs for acupuncture, chiropractors, eye doctors, psychiatrists, weight loss programs, treatments for drug and alcohol addiction, eyeglasses, contacts, wheelchairs, hearing aids, LASIK surgery, other durable medical goods, implements and supplies, smoking cessation, program costs, and lactation supplies, among others. They all go on the Schedule A on lines 1 to 4, which is where that calculation I talked about comes from. And in order to qualify, these have to be pretty much prescribed for most people. If you're just going to the store and purchasing Tylenol, that's not going to be something that goes on there. Okay, so these are things that need to be prescribed by an appropriate medical professional, qualified physician, etc., in order to be deductible on the return. They also cannot be reimbursed by insurance or through other means. If you are reimbursed by insurance, you will need to take that reimbursement cost out of the picture, and only the amount that the client themselves is specifically paying and not being reimbursed for will be included in these costs. There are some over-the-counter purchases that are acceptable. The reference to the durable medical implements, things like crutches and so on, diabetic supplies, insulin and insulin needles, testing strips, etc. Some of those things can be taken as a cost for this purpose and potentially deducted without needing to be prescribed necessarily. And medical mileage, when there is medical mileage that is exclusively for medical purposes, is 21 cents per mile. That's the 2024 value, and does include also the cost connected to, if any, for parking fees and tolls. If you want more information on the specifics of this in more detail, you take a look at publication 502. Next, we have taxes paid. Very first thing, Schedule A, line 5A, are state and local taxes. Now, you have one of two choices in this. You can use the actual taxes off of Forms W-2 or use the local tax table, in the sense that the taxpayer needs to choose between whether they're deducting income taxes or sales tax. There are 7 states in the United States that do not have income taxes, and therefore the sales tax would be the only option. Otherwise, if they are in a state that has both, they would need to choose which of the two would apply. Most of the time, it is going to be income taxes. And it's an either-or situation. It's not both. There's no mixing and matching here. Sales tax itself can be done basically in one of two ways. If they manage to keep receipts during the year for all of the purchases they made, and they have a copy of their actual out-of-pocket sales tax cost, they could use the actual receipts themselves to put it on there. Otherwise, they use a sales tax table, the instructions for which are inside of the Schedule A, and also, generally speaking, there's usually a worksheet which can be attached in most commercially available software platforms of any worth. Now, regardless of method, whether you're doing the actual receipts or you're using a sales tax table, if you have sales tax that's paid on large purchases, like cars, boats, aircraft, the sales tax on material purchases for very large home renovations, etc., those large purchase values can be separately added to the tax table method if you use the tax table method. The tax table method essentially has you place down the tax rate in your state and local jurisdiction and use certain types of new alphanumerical codes on the actual form itself to figure out what value to place on it. Generally speaking, using the software, it's a fairly straightforward process. You may need to become familiar with how to find what a local sales tax rate would be in order to calculate it. But once you've done that enough in your area, you should kind of know what the sales tax is at both the state and regional / local, county / city level in order to apply it to the most common itemizing clients that come in. Now, this is subject to a $10,000 SALT limitation or $5,000 for married filing separate from 2018 through 2025. And when I say SALT limitation, I mean state and local tax, SALT, state and local tax limitation. One of the ways that the previous administration attempted to make this as revenue neutral as possible to avoid getting filibustered through the Byrd rule was to have certain types of cost saving measures inside of them. And one of those was limiting the impact of the deduction of state income taxes, which disproportionately was beneficial to both East and West Coast or large city taxpayers who had a lot of income taxes to pay. People in New York, people in Chicago, California, and so on. And those individuals who would have much more state income taxes to deduct are capped at a total value of $10,000 regardless of how much they actually spent. Next, we have real estate taxes, and real estate taxes are going to go on the Schedule A, Line 5B. This one is one of the most common ones that you'll run across, in addition to the state income taxes, principally because most people who itemize are homeowners, and they're going to be attempting to claim their mortgage interest paid. So for real estate taxes, the only amount that you're able to use is the amount that is actually paid and not the amount assessed. Now, for most of you, this will be easy because the amount paid will probably be listed in an other box on a 1098 from the mortgage company because they're most likely paying their real estate taxes in escrow or through escrow. But if they do not have that set up where they're paying it through the mortgage company, they might have property tax assessment paperwork. Potentially they get one twice a year. And a lot of times those amounts will show amounts that are assessed instead of amounts that are actually paid. And the payment portion is a separate receipt, which may or may not be present, or it may show an amount assessed and then the amount paid for an earlier period. So you want to make sure that you are getting the appropriate amount that they paid physically to the appropriate taxing authority within the appropriate time and for the appropriate property. And that is really important to take into account, especially if your clients are doing things like rental income and so on, because those types of costs, if they're doing rental property, would need to be associated with the appropriate property and not just as a catch-all collectively put together on the Schedule A. These amounts, in order to be deductible, like all of the taxes that can be deductible, must be uniformly levied across the jurisdiction. That's a pretty standard treatment for what is considered deductible on a tax return, is it needs to be applied to everybody in a similar situation within whatever that jurisdiction is. So you don't get deductions for one-off taxes for real property or for a small area. If there is an increase to taxes because of some local benefit, local easement, or something similar, then those amounts, those small easements, tax increases, etc., they are still beneficial to the taxpayer, just not as a deduction. They increase the basis, which means that they add on to the cost of the home, and if they ever sell that home or depreciate it or convert it to business use or something, then that value will be added to the cost of the home along with any other improvements to the property that increase basis, okay? Now, this is also subject to the same $10,000 / $5,000 SALT limitation. And this particular one This limitation, by the way, has made a significant difference in itemizing for high tax states and higher income clients that might not be offset by tax savings due to rate decreases. So the general overall rate decrease on the ordinary income tax might not be actually beneficial and might be either neutralized or reversed because of this particular limitation. This limitation itself is also one of the reasons why there are strategies at various state levels to offset this, which I can talk about in a minute. Next, we also have personal property tax, which is based on the value of property that you are paying. Personal property tax, most common one that I would see people have is the personal property tax that's connected to registering their vehicles. Okay, so they go to the DMV or BMV, whatever the name is, or this appropriate agency in your state of residence or for your clients, and they get their car plated, get their tags updated, etc. There is a portion of that that can be deducted as taxes. You can't take individual fees and stuff. It has to be based on the value of the property, not based on the weight, not just a flat fee. But usually the receipt will contain a breakdown that shows the amount that's actually deductible. It needs to be assessed and imposed annually, even if it's not collected annually. That distinction is important because there are, for instance, East Coast states that have annual assessment but only collect every 2 years. You would need to find out what amount has been imposed on that annual basis and what amount's applicable to the year. In either case, it needs to be uniformly levied. If it's a one-off or a special tax or a fee or something like that, then it would potentially add to basis, but otherwise isn't something that is going to be considered deductible. And this, just like the other ones up to this point related to taxes, are also considered SALT limited. And then finally, we have other taxes paid. That's on the Schedule A line 6. These are things like income taxes paid to a foreign country or generation skipping transfer tax paid on certain types of income distribution. If you do have somebody that has foreign taxes being paid, it's probably better to try to take a credit through the Form 1116 or Form 1116 for the foreign tax credit instead of trying to do and use them as a deduction, because credits, like I said, have a higher punch, because it's a dollar credit becomes a dollar against tax as opposed to a deduction of income and a percentage reduction in tax. You also want to make sure that in this value, you don't include taxes to pay or paid to U.S. possessions. That is a Schedule A line 5A value, or estate tax paid on income in respect of a decedent, which is a Schedule A line 16 deduction from one of the miscellaneous deductions instead. And before I move on to talk about home mortgage interest paid, I do want to point out that many states, California and New York are both two of them that I could think of off the top of my head that have strategies to get past the SALT limitation, particularly for people who own pass-through entities that allow them to basically voluntarily choose a higher tax rate and pay taxes through the business, which then carries down to their Schedule 1s because they get a direct deduction against federal income for the amount of taxes that they're paying on their gross income, for instance. And then it gives them essentially withholding credits at the state level. So their income gets taxed, they get the withholding, they get a refund of any withholding that is in excess of the amount of their assessment. But more importantly, those taxes paid are deductible expenses at the federal level. So they bypass the Schedule A by directly reducing income. And it is entirely legal and has been adopted by many places that allow for voluntary withholdings at the state level and at the business level for the purpose of getting past the SALT limitation during the suspension period. And probably will continue after it as well. Next, we're going to talk about deductions on interest paid for first and second mortgages, your home mortgage interest. So you can deduct the interest that is paid on your primary and secondary homes. Interest on home equity loans suspended by the TCJA, and the interest on refinanced mortgages was affected by the TCJA, although I will say there are workarounds, kind of, for both of those. Now, what is a home? House, condo, mobile home, boat, etc. I kind of talk about this in both the dependence webinar and the filing statuses webinar, that a home is essentially a contained unit that needs to have a sleeping area, some kind of toilet and or bathing / cleaning area, and a cooking area. If it has those three things, then it can be considered a home. It doesn't have to be a physical structure attached to a slab on the ground with a framing and a roof, windows and a door and so on that is anchored in one specific area. In order for it to be deductible as well, the loan must be secured by the property, as in the bank can take the house or demand that the property be seized to satisfy the value of the loan if the taxpayer were to default and have to go through a foreclosure. So the loan itself uses the house as collateral. The deductible portion of this only pertains to the first $750,000 of what is known as acquisition indebtedness. And that is the total amount of indebtedness that is related to acquiring the house. That $750,000 is the limitation. Now, pre-act, that was $1 million and also included a $100,000 equity loan limitation. Okay. And more so than ever in the past, the terminology itself is less important than how the funds are actually used. So don't worry about things being called equity loans necessarily. You might have somebody with a home equity line of credit, a HELOC, right? Equity loans may still be qualified for treatment as mortgages and the interest being deductible in this fashion if in the material fact the loan is indeed a misnamed mortgage. Similarly, if you have a refinanced mortgage but it isn't used as a mortgage and it's used for some other purpose, you got to be careful to think about how the funds were used and the effects of things like cash out refinances and how it's actually spent. The key impact here is buy, build, or improve main home. Okay, that's the idea of what a mortgage is. You have a loan secured by the property. If you get either a line of credit or you refinance the mortgage and those costs are used to buy, build, or improve a home, because a mortgage can be obtained for the purpose of building a home as well. It's not just purchasing one that already exists. So if the funds are used for buying, building, or substantially improving a home and the loan itself is secured by the property in question, then it could be considered a mortgage even if it's called a home equity loan. Now, you might want to keep proof of these things in case the IRS happens to question the veracity of it being on the return, but that is something that you need to keep in mind when you are looking at people who have done things like cash out refinances, who have home equity lines of credit. And if they are spending it on non-home related things or personal things, you either could exclude it or you could apportion it. If I took a cash out refinance on my house and used half of it for a renovation and half of it to buy a boat or something, half of that amount of interest would be potentially deductible as home mortgage interest, while the other half would be excluded. Now, this is in effect from December 15th of 2017. Anything older than that is grandfathered under the old limits. So home equity lines of credit, deductible up to $100,000 regardless of how they were used. Home mortgages, the interest is deductible for acquisition indebtedness up to $1 million. Now, most people don't have homes that are more valuable than that, but if they are, you just need to proportionally assess and reduce the amount of the potential deduction by that value. And that may be easier said than done, but the easiest way to do it is to take the total amount of the limit compared to the total amount that they have actually obtained in acquisition indebtedness, turn it into a ratio, and then multiply the interest by that. To give a very quick and easy example, $750,000, okay, is the limit. For the sake of argument, let's say they have $1 million mortgage, right? Well, 750,000 divided by $1 million is going to give you 75%. So in this particular case, if they're paying interest on $1 million property, but the limit is $750,000 in its acquisition indebtedness, and the ratio is 75%, I'm going to take 75% of whatever the interest that I'm paying is. So if I paid $40,000 in interest in a year on $1 million property and I have a limit of $750,000, I'm going to take a $30,000 deduction instead of a $40,000. And that extra $10,000 is just basically lost for the purposes of itemization. Now, this home mortgage interest goes on the Schedule A, line 8A for all of the mortgage interest that is reported on Form 1098, or on the Schedule A, line 8B for mortgages that are not reported on a Form 1098, like, for example, seller financed or personal mortgages. Anything that is done as an informal mortgage that's not going through a bank gets reported on there. Schedule A line 8C, however, can be used to report points that are not reported on the Form 1098. Mortgages can provide a substantial tax benefit. They are often the tipping point item on determining whether or not taxpayers are going to be able to itemize. And the 1098 is therefore very important. Also, as a side note, 1098s where the mortgage company is paying for the real estate taxes essentially in escrow will usually have those amounts listed in the bottom of the 1098 in the other information section or in a supplementary statement. Now, in the interest of time, I'm not going to elaborate too much on points, but points are basically whole percentages of the value of the mortgage that can be paid off and they can be deducted. They can be deducted if they are common in the area, but not more than an amount that's usually charged for that same area. The loan is secured by the main home. The cash method and the amounts not paid for separately stated item or not paid for separately stated items like appraisal fees. The funds provided and any points that the seller paid are at least as much as the points charged, and that there's no borrowing from the lender or broker in order to pay these points. The loan itself was used to buy or build a main home. It's computed as a percentage of the principal, and it is clearly shown as points on the settlement statement. If necessary, you could go through and look up home mortgage interest deduction points, IRS, take a look at the IRS's tax topics and so on, and get more information if you need it. So far to date, every single time I have ever investigated any of these facets to see whether or not the points were eligible to be deducted, they have been deductible. I'm not saying that it's impossible for them to be not included, but so far to date, I have never run into a situation where they're not eligible to be placed on the Schedule A for itemizers. And then last, we have mortgage insurance premiums or principal mortgage insurance or primary mortgage insurance. This is listed as being deprecated because it was eliminated by the TCJA, brought back for 2020 and 2021 because of COVID legislation. You know, anything that they could do to help that situation out for taxes was kind of sort of in the air. And it was retroactively allowed back in 2018 and 19. It was deductible if it was qualified, meaning that the qualified mortgage insurance was mortgage insurance that was provided by the Department of Veterans Affairs, the Federal Housing Administration, or the Rural Housing Service or their successor organizations, and also amounts that were covered by private mortgage insurance. It originally went on the Schedule A line 8D, and it had phase-outs that were based on AGI that started at $100,000 or $50,000 for a separate filer, and then reduced by 10% by each $1,000 that was over the limit, which means that at $110,000, you would have lost it for pretty much everybody. Now, this is not in play. It's a hot ticket item. People do want it back, but it is not currently deductible. But being a 2024 return, you'll be able to file 23 and 22 returns electronically and do paper filing for 21 returns in order to potentially claim any refunds within the statutory time period, which might potentially mean you being able to do MIP or PMI deductions on a Schedule A for a person who did not file in 21. I will say, generally speaking, most people in the country filed in 2020 and 2021 because of the stimulus payments. So that as normally I would say that this might be an opportunity, but generally speaking, most people who needed to file or just even didn't need to but wanted to already did so for those years. But if you do have a 2021 person that comes in with 2021 information and they have PMI on the return, it is in fact deductible for that year. That is the last year that it can be treated as such. Okay, we are back for another polling question. We got one more polling question after this. I'm going to go ahead and try to keep this one quick in the interest of time, so give me just a second to pull it up and we will continue. All right, we're back and we're going to go ahead and talk about gifts to charity. So when we're talking about gifts to charity, in order for them to be deductible, they have to be made to qualifying organization. One of the very first and most common ones are religious organizations, churches, mosques, synagogues, temples. If they are a religious organization, probably 501c3, any contributions that are made to any one of those that has gone through and gotten their official tax exemption and are good with the IRS, eligible to be placed. This also includes charitable organizations as well that are potentially religious or non-religious. That's not really a requirement. In nature, things like Goodwill, Red Cross, United Way, Doctors Without Borders, so on. This also includes educational institutions like nonprofit schools, Boy Scouts, etc., scientific, fight to find a cure, raising money for particular types of disease, or conditions, disorders, so on, things that prevent cruelty to children or animals, humane society, etc. The types of donations can be cash, check, or charge, cash equivalent donations. Those go on the Schedule A, line 11. They can be non-cash donations, Schedule A, line 12. They can be mileage that is driven for charitable purposes, which is at a flat value and has been for many years at 14 cents per mile. And there also can be prior year carryovers because there are limitations to the amount of charitable deductions that can be taken on a return, and those get placed on the Schedule A, line 13. In order to justify this, taxpayers must have records to prove all cash donations, whether it's a canceled check, credit card statement, written receipt from the charity that has a name, date, amount, and so on. If anybody has cash donations or cash equivalent donations over $250, then they are supposed to have a statement from the charity showing the amount of money contributed and whether or not any goods or services were given in return, and if so, have the value of those goods or services received removed in return from that value. All non-cash donations need to be listed at the fair market value, and the taxpayer must be able to justify those valuations. If they have anything over $500, then that needs to be entered onto a Form 8283. The taxpayer needs to keep the written records of the organization's name, address, date, and keep a record of how their value was determined. And if they have something like a boat, automobile, airplane, etc., there must be an attached statement from the charity to the return. So what we're getting at ultimately is that any large non-cash donation needs to have who received it, what was donated, where it was donated, when it was purchased, and how the value of that property was determined. All that information gets entered onto the 8283. And this, by the way, is not completely exhaustive of all of the conditions when you start getting into large things. If valuations are over $5,000, they need to also have a qualified appraisal. If you have vehicles, you might need to have 1098C. There's a lot of stuff that could potentially go into this. And when we talk about having proof, this is the taxpayer having proof to justify it in case the IRS asks for it. For you as a preparer, ask for whatever you feel comfortable with. Just make sure that your duty to advise is being kept, and that if you are taking the taxpayer's word for it, that you're letting them know, hey, if the IRS asks, they're going to want to see A, B, C, and D, and you're going to need to be able to promptly provide it for them. And just as long as you know that, I can put this on the return, but make sure that they're aware that it's their name, their taxes, their information connected to it. Now, charitable contributions at the moment at the federal level are generally limited to 60% of AGI for most types of donations, but there are contributions that may be limited to 30, 20, or even further, like lower percentages. If you want more advanced rules and an in-depth explanation of them, you can find them inside the publication 526, which does include reduction worksheets and carryover information for future years. There are also a lot of worksheets that are available in commercially available software platforms. And there's also a various list of contributions which cannot be deducted under any circumstances. A notable post-act change was contributions that are made for access to seating rights at college stadiums. So making a donation to the school and then receiving essentially permanent seating at that university's sports games was made ineligible to be treated as a charitable contribution. Also worth noting that not every state is conformal with the 60% AGI limit, and that it has at times been higher. So during the COVID timeframe, there was a 100% of AGI. So you were allowed to donate up to 100% of your AGI for those particular years. So it's worth it to take a look at the situation if you are doing prior year returns. Now we can talk about casualties and theft losses. Casualties and theft losses are losses to personal effects, property, income producing capacity, and so on that are related to disasters and acts of crime and other similar types of unforeseeable consequences. Okay. Post TCJA, the only personal casualties and theft losses that are deductible are those that are related to federal disaster losses, and qualified disaster losses. Those terms, by the way, are described in Pub 547, and they basically hinge on treatment as a federal disaster. And then pre-TCJA, those were used for losses that were not reimbursed by insurance, not necessarily connected to the declaration of something being a federal disaster. And that, like theft, vandalism, fire, storm, failed institutions or financial institutions, etc., those are all subject to AGI limitations. And then those who were victims of a Ponzi scheme were not subject to either the AGI limitations or the $100 per instance reduction that is present for the casualty and theft loss. Now, each casualty event itself is reduced by $100, and then the loss is only deductible to the extent that the gross loss amount is above 10% of the AGI after that $100 limit. So qualified loss minus any reimbursement minus $100 compared to 10% of the AGI. Whatever the excess is, that is considered deductible. It requires the completion of a Form 4684, and then itself is carried over and placed on the Schedule A, line 15. Taxpayers with a qualified net disaster loss can take those losses by completing that Schedule A and then including the value and attached Form 4684 on the return, and it can be taken on a return without itemizing. And there is an instruction set inside the Schedule A instructions for more details on it. And those losses, by the way, are connected generally to specific named like hurricane disasters or other similar types of natural disasters. So if you're in one of those situations, take a look at the Schedule A instructions for how to handle that one. Now, the limitation on not being able to take casualty losses without a federal declaration is related to personal casualty and theft losses. Your business casualty and theft losses can still be considered deductible. And like I said before, there are some special rules for Ponzi schemes. What you want to do is to make sure to take extra care if you are helping a taxpayer take disaster and theft losses if they are not in a federally declared disaster area. It is a major audit target, so you want to make sure to exercise all the due diligence, keep your notes, records, and so on, and make sure that the taxpayer has all the records and knows what they need to keep when they are filing in case the IRS ever does ask them questions. And moving on to miscellaneous deductions, these are everything else, and they go on the Schedule A, line 16 as a total figure and potentially with an attachment showing the types and amounts for each category. These are not subject to the 2% of AGI floor. Now, I've mentioned that before. 2% of AGI floor. I've seen people call it the 2% haircut. Those were the deductions that could be placed on the Schedule A only in excess of 2% of AGI, like tax prep fees, unreimbursed job expenses, and so on. But the ones that we're talking about now are not subject to that limitation, and they include, as an example, amortizable premiums on taxable bonds, casualty and theft losses from income-producing property, federal estate tax on income in respect of a decedent, gambling losses up to the amount of gambling winnings, and repayments of more than $3,000 under a claim of right. And there's publication 529 has more information on every single one of these. Now, due to requirements that we have for handling things like, for instance, California and some other states where they might need to have descriptions or they're not conformal to the IRC, we're going to talk very briefly about job expenses. In a federal sense, these are suspended by the TCJA until tax year 2026, with the exception, of course, being for that above-the-line adjustment that uses the same Form 2106, to which these are still okay. These are not going to be available for everybody. I'm not going to go through and every single line on this. Long story short, they used the 2106. It was a 2% of AGI deduction. Business expenses needed to be ordinary and necessary, as in common and accepted, helpful and appropriate for the business, and they did not have to be required to be considered necessary to be deductible in those particular cases. Examples that most people would apply, things like safety equipment, protective clothing, work boots, tools, supplies, machinery, computer supplies and programs, union dues, professional organization fees, any required travel and lodging expenses. They could also do business use of home by doing an 8829 long form and doing a percentage apportionment and potential direct costs for their home, or the simplified method, the same as you would find on like a Schedule C, for instance, of $5 per square foot, up to $300 or up to 300 square feet, and a total potential maximum home office deduction of $1,500. The other 2% deductions that were also originally present, tax preparation fees and other expenses, respectively, went on the Schedules A, line 22 and 23, still deductible in some states, California, for instance. That line 23 amount included things to produce or collect taxable income, manage, conserve, or maintain property held for producing income, and to determine, contest, pay, or claim a refund of any tax, 2% haircut, 2% AGI floor, and Publication 529 was where the information for that was present. Now, very quickly, I want to talk about deduction versus expense, because a lot of people will say deduction as a catch-all term, as I mentioned earlier. Expenses are those costs, which are deductions essentially that count against income in an economic activity. Business versus hobby, for example. If I have expenses that I'm paying because I'm operating a business, then I could be able to take those against my business income. If I'm doing something as a hobby, have a little bit of hobby income, used to be able to itemize those and be able to take those against as a miscellaneous 2% deduction. In this particular case and in this time frame, however, most of your expenses for non-business related things are not going to be deductible. Okay, with the exception of the renting of personal property adjustment that I mentioned earlier, expenses connected to that, you're not going to be able to take them. Generally, though, expenses do reduce income dollar for dollar, but as a consequence, they go on to whatever the actual form is. If you have a Form 1099 NEC, miscellaneous, or K income, then those are going to be expenses on the Schedule C or F. If you have Form W-2 income, you would put the 2106 onto the Schedule 1 if they're the right type of worker, fee basis government official, qualified performing artist, armed force reservist, etc. But for everybody else, you're not going to do it. So don't take expenses against regular income if the taxpayer has no legal right to do so. That includes making a fake Schedule C with expenses just to drop them below or maximize their credits. That is something the IRS looks for specifically and goes after with righteous indignation and fury. There are also some other things that are often called or attributed to being tax deductions, but are not at all. They're not deductible, and in many cases have zero impact on any type of tax consideration. Child support, cost of living, personal expenses, food, rent, utilities, personal legal fees, fines and penalties like speeding tickets and so on, donations to family or interested or personally connected parties, credit cards or car note interest for personal use, any personal non-income generating purchases, and so on. If it's not connected to the production of income as an economic activity that is being reported on the return in some fashion directly, it's probably not going to be deducted. Now, child support, food, rent, utilities, those types of things can be useful for support test determination, trying to figure out whether or not a person is taking care of the support needs for seeing if dependents need to be on the return, but it's not going to get placed on a Schedule A. It's not deducted. You don't get to itemize it and so on. You don't get to take deductions for paying child support. None of that matters. All right, this is going to be the last polling question. If you are attending this live, this is the last polling question that you need in order to register your attendance for today's presentation. Otherwise, this will be the last interactive review question if you are watching this after the fact, and we have hosted it up on the website. So I'm going to go ahead and get to it in the interests of time, and then we will close this out with a little bit of extra information and then be done for the day. Up to this point, you've heard me say due diligence a number of times, and you may have attended the due diligence-based ethics webinar over the Circular 230 that I did a couple months ago. If you haven't, then when I say due diligence, what I'm referring to is the level of judgment, care, prudence, determination, and activity that a person would reasonably be expected to do under particular circumstances. In general, what you do is you can rely in good faith on the client-provided information, but you cannot ignore the implications of the information that is known or reasonably suspected to be untrue, incomplete, inconsistent, or inaccurate. And the preparers, you guys, can face heavy penalties, fines, and jail time for failing to abide by due diligence. So receipts, proof, Tell clients to obtain and keep them accessible. Your schedules C, F, and E, etc. should not be used to take disallowed employee business expenses. You can also have clients sign or acknowledge in a provable way some form of disclosure statement if you need or still want their business but feel that you need protection, because the IRS can come back to a return years after it is filed. If they believe something is fraudulent, there is no statute of limitations, which also means, by the way, watch out for any mileage claims, and that's just in general. Now, due diligence as an actual core concept, specifically with regard to preparation, applies generally to earned income tax credit, child tax credit, American Opportunity Tax Credit, and the head of household filing status. Okay? Anybody that has a professional credential, however, enrolled agent, individuals who are subject to the OPR, like record of completion holders for the annual filing season program, CPAs in good standing, and attorneys in good standing who are able to practice and do tax preparation. All of these people have due diligence that expands beyond the scope of just those 4 specific topics. And what I say is they need to be made aware of the consequences for noncompliance. And you can't ignore when you know the actual truth. But if they're making a claim and they claim that they have the proof and you don't have any reason to suspect otherwise, you ask the necessary questions, you've covered your bases, maybe even had them fill out a worksheet and sign off on it, whatever you feel comfortable with, you can put it on the return because they're ultimately the ones that have to sign up for it. But you just have to make sure that you are protecting yourself as well as letting them know how to protect themselves. Now we're going to talk very briefly about P's limitations. I am not going to read all these slides. This is kept up here for historical purposes and satisfying certain state regulations, because this doesn't apply at the federal level. It only applies at the level of some states. The long and short of it is that there were limitations outlined originally in IRC Section 68B that were repealed by TCJA from 2018 through tax year 2025. There was an upper threshold based on your filing status that once you hit that, it began to reduce your deductions and also phase out your personal exemptions. As of right now, personal exemptions don't exist at a federal level, but when they did exist, they were also reduced by this exact same process. Now, taxpayers who exceeded it reduced their itemized deductions by either whatever their AGI over the threshold was by 3%, or reducing their deductions to just 80% of whatever the allowable amount was. So either AGI minus threshold by 3%, or itemized deductions as a total multiplied by 80%, and reducing the personal exemption threshold by 2% for every $2,500 over that threshold until they disappeared. And the net real effect was basically about a 1% surtax on the top of the marginal tax rate. And then I have a listed example here. They are available in the version of these handouts that you can either access from the continuing education portal, or if you're attending this live right now, over in the handout section if you haven't already done so. And this is using old numbers because, like I said, these are gone for right now. And another example right here. And then finally, to close this out, interest tracing. Now, interest does have multiple uses based on the context in which it's paid. If it's personal, it's generally non-deductible. Obvious exceptions for, mortgage interest as an itemized deduction, right? Investment interest is usually limited to net investment income with the excess carried forward. If you have residence interest specifically as a subset of personal, it's usually itemized and restricted based on the tax law when the property was acquired. If you have it connected to passive activity, then it's limited to passive income with potential carryover. And trade or business interest is generally deductible if the taxpayer is an active participant or materially participates in a business, although there are limitations to the amount of business interest that can be deducted as well. Treasury Regulations Section 1.163-8T identify the IRS's interest tracing rules. They focus ultimately on how the proceeds of any loan are used in order to determine the deductibility of any interest paid. The property that's used to secure the loan does not affect the way that the proceeds are traced. The loan usage stipulates the treatment. And the short version of these rules is that the usage must be apportioned, if possible, between the appropriate type of treatment based on the ratio of use. If I have a loan 50-50 used for a tax deductible and a non-tax deductible purpose, then I would have to split the amount of deductible and usable interest by 50% and apply it to its respective categories. All right, this is a list of clickable resources that's available in the handout. You can see a lot of these things here. Obviously, feel free to take advantage of them if you need to. And then if you are here for the live presentation, you can use the question panel over on the side. I almost always have a Q&A session for anything that came up. It can also be contacted at the email at the bottom of the screen. If you were purchasing this from a reseller and did not get it directly from Federal Direct Tax Services or preparetraining.com, feel free to reach out with any questions, comments, or concerns to your provider of choice. Otherwise, I'd like to thank you guys for attending today. I hope to see you at next week's presentation. And just wanted to let everybody know that we will be off this weekend for an extended amount of time due to the Labor Day holiday. I'd like to thank you for being here, and let me know if you have any other questions. Thanks. Bye.